So if you're a medium term to long term investor in equity market, and if you really want to understand whether the market is fairly valued, undervalued or overvalued, there are two important factors one should look at it. One is the corporate profitability and second is P multiple. Let's look at the first one, corporate profitability. So here is data for last couple of years and next 2 years. So if you look at it, the earning per share of Nifty 50 companies actually went up by 10% in 2021. In 21-22, these numbers went up by 49%, one of the highest growth that we have experienced in last so many years. But that's all done and dusted. Market looks at future, and hence it is important for us to look at what is going to be the growth expected in this financial year, which is 22-23 and 23-24. So what are our expectations is that these numbers will grow about 15% in this financial year and 12% in next financial year. So what's the basis of this expectations? So what we have seen is that the earning per share of corporates has always grown up by more than 5% than the GDP growth. That's the long-term average. And we all know that India's GDP growth about 7% expectations in this financial year. And hence the calculation is 12%. So these are the numbers which is 12%, 15% are really, really healthy from the equity market point of view. Let's look at what is happening in this financial year. So first quarter numbers are already out. And if you see the first quarter earning per share growth is about 19%. That is all what has happened, right? And hence this is much, much higher than our expectations. And that's why we have revised our expectations to 15% from 12% for this financial year and 12% for the next financial year. And we keep on tracking this data every quarter and we'll keep you updated about this expected growth end of every quarter. So now if you have to look at it, whether market is fairly valued, undervalued or overvalued. As I mentioned, the second parameter, which is P multiples, which means how many times market is trading basis the corporate earnings. But mind you, this is not the corporate earnings what has happened in the past, but what is happening in the future. So 1 year forward earning is very important. As I mentioned, market looks at future. So if you look at the past data, market has always been trading about 18 to 19 times than the 1 year forward earning. So with this calculation, let's look at what is the current level of Nifty. So it is 17,094. And if you look at the expected earning about 20 to 23, it will be about 890. So if you multiply that by 19 times, which means about reasonable level about 16,910, which is just 184 points higher than the reasonable level of Nifty. Or in other words, there is only 1% fraud in the market. But now if you want to invest today, obviously you would want to know what is going to be the reasonable level of Nifty 1 year down the line or 2 years down the line. So the same calculation for today's level of Nifty, we have looked at the 1 year down the line, which is 22-23 earning. If you have to look at it, what is going to be the reasonable level of Nifty 1 year down the line, you have to look at it, the earning per share of 23-24. So let's do the calculation again. So current level of Nifty is 17,094. Expected earning of 23-24 is about 997. We have already seen the growth of 15% and 12% in the past, right? So if you multiply that by 19, the reasonable level of Nifty 1 year down the line should be about 18,943, which means there's a clear-cut growth about 11% over Nifty from this level. And if we have a well-managed mutual fund portfolio, which will give about 2 to 3% higher than the market, you can clearly expect about 14 to 15% returns in next 1 year time.